It's time to buckle up, folks, as we've got groundbreaking information to share with you. Because of the unprecedented geopolitical turmoil with the Trump presidency and the financial markets, Kenneth Amaduri of Crush the Street has invited David Stockman, who previously served as the director of the Office of Management and Budget under President Ronald Reagan, to share his thoughts as well as discuss his brand new book, Peak Trump: The Undrainable Swamp and the Fantasy of MAGA. Given his extensive track record, we've compiled a list of his accomplishments and analyses at crushthestreet.com/David. With so much dynamism baked into our markets, you can't afford to miss this vital information. Once again, please visit crushthestreet.com/David. And now, ladies and gentlemen, here's David Stockman.
Hello, everyone, and welcome into crushthestreet.com. Another hard-hitting interview I have for everyone today. It's a New York Times bestseller, David A. Stockman. He's the ultimate Washington insider and someone who's sounding the alarm. He's got a resume that, it will just blow anyone away. Director of Office of Management and Budget for President Ronald Reagan. His website is David Stockman's Contra Corner. We'll have the links in the description area. And he's got a brand new book, Peak Trump, which we'll get into today. David Stockman, thanks for coming on Crush the Street with me.
Very happy to be with you.
Sir, let's start here. Let's start here. You were on CNBC, and I got to say, you were hammering Trump on his economic policies enough that the hosts of the show were actually playing devil's advocate and having to say some good things about him, which is kind of an odd thing. But with that in mind, tell us a little bit about this book and, some of your thoughts on what's going on with Trump now.
Yeah, well, on that CNBC show, they were defending Trump, but only indirectly, not him, but the market, because I'm basically saying in Peak Trump that the market peaked September 20th last fall after a 30-year run of massive debt in our private and public sector, a Federal Reserve that went from a $200 billion balance sheet when Greenspan started in 1987 to the peak of 4.5 trillion last fall, and that we're at the end of the road. That this was really an unsustainable fantasy. You can't borrow and print your way to prosperity. You can create great bubbles. You can create artificial expansions for a apparently extended period of time, but you can't defy the laws of sound finance and honest money indefinitely. And so I insist that we're in for a big correction sometime in the next year or two, that recessions haven't been outlawed by the economic gods. We're at month 116 of this current expansion, the second longest in history. 119 months is the longest, and that was the 1990s tech boom, where circumstances were far more benign and propitious, let's say, than they are today. So there's no way that we'll make it to November 2020 without the next recession incepting. And when it does, the stock market will crash, and Trump will be in a pretty serious retreat, because he promised to make America great again, and that was at least as to the domestic economy. And yet he's adopted policies that will only make it, more indebted again in terms of massive expansion of the federal deficit, but also the enormous pressure on the Fed not to normalize, not to shrink its balance sheet, and thereby to somehow keep debt flowing to the private sector and to Wall Street, and thereby perpetuate, this artificial prosperity that we have going now. So his policies are only going to make things worse. The trade war only compounds it. And they didn't like to hear that. I guess I was down there at the New York Stock Exchange because, the bubble vision people are there to cheerlead the market and insist that whatever it takes, the government needs to do whatever it takes, the Fed, the fiscal authorities, to keep the stock market going higher, whether that makes sense, whether that's sustainable, or whether that's honest, constructive policy or not. So every time I go on CNBC, we tend to get into that, that dispute because, the whole financial market is caught up in what I call the Draghi syndrome, whatever it takes. And it doesn't matter how bad it is, and how unfair or unsustainable it is, and we can get into a number of those factors. The idea is just keep the ball moving 1 yard at a time, keep the index rising 1 point at a time, and we'll worry about the future in the by and by. Well, that has lasted for a while. I agree, but I don't think it is the basis for a permanent prosperity.
Sure. Well, I tend to agree with you on that. I know you're speaking very objectively. You've looked at the numbers and you're saying, hey, this is what I see, this is what I think is happening, and this is where the facts are indicating the way things are going to play out. But I'd like to ask you, what are your personal beliefs, or what do you desire, or what would you like to see happen? Whether it's the Trump presidency or, policies to play out that would best help this situation?
Well, I think we have to get the country, both the public and the private sectors, off this debt kick, number one, and I give some numbers about that in a second. And second, we need to get the Federal Reserve the hell out of the financial markets, off Wall Street, and bring the free market back in and let prices be set by supply and demand and all of the massive wisdom that exists among the tens of thousands of people that might be trading the markets if it were a level playing field, if they were two-way markets and supply and demand rather than Fed speakers and Fed interventions were controlling the day. Those are the two big things that would make all the difference in the world, because the debt is so great. There's 70 trillion on our economy today, public and private, that it's suffocating growth. And the Fed is so out of control that it's basically bifurcating the economy, creating endless and ever more egregious bubbles on Wall Street, even as that detracts from Main Street and leaves Main Street basically flatlining. In my book, Peak Trump, I use one statistic which I think quite dramatically proves my point, and that is if you go back to the fall of 2007, before the crisis, kind of the peak before the crisis, assume we're somewhere near a peak today in the next cycle, 11 years later. So the way to measure the economy is always peak to peak or trough to trough, but never peak to trough or trough to peak, because that's just, talking point spin. It's not honest analysis. But if you do that, here's what you get. On the stock market, Wall Street side, the NASDAQ 100, which is really the leading edge of the tech boom in the stock market that we've had over the last decade, it was up 200% as of the highs last fall after inflation. So I'm saying even if you allow for inflation, that's a 200% real gain in the leading index of the tech-based stock market boom we've had since the crisis. On the other hand, if you go to Main Street, there are three good things to measure. One is labor hours put to work. The second is industrial production, which includes both utilities, energy, and manufacturing. And the third is household median real income. Compared to the 200% gain on Wall Street, what you have on Main Street is zero gain in household real median income. 3% only over 11 years gain in industrial production. That's nothing. It's a stagnating economy. And only about a 7% gain in total hours employed, which is the right way to look at the labor market. The unemployment rate is totally meaningless because it counts apples and oranges and kumquats. What I mean is, if you work 10 hours a day at McDonald's at the minimum wage, that's a job. And if you work 60 hours a week overtime in an auto plant, making 80,000 a year fully loaded, that's a job. Well, they're not comparable. But if you look at hours, at least you've got some better metric on what's going on in the labor market. And the answer is 11 years, less than a 7% gain in the total hours employed. So, just think about that then. 200% on Wall Street over 11 years, practically nothing, a flat line on Main Street. That can't be sustainable. That can't be reality, because at the end of the day, stock prices are nothing more than discounted economic and cash flows, discounted growth of the economy and cash flows of the companies that comprise it. And there's just no way you can have one going 200% and the other going nowhere indefinitely. It won't work. So I think this apparent decoupling has been entirely artificial. It's been driven by a out of control of Fed, which has stimulated huge bubbles with cheap debt and massive liquidity injections through its bond buying into the stock market. But at the same time, it's hurt the Main Street economy far beyond what they would ever admit, or even what critics point out. But I think it's important to note that when you turn the stock market into a casino, and that's what it is, it's a gambling casino, you essentially encourage the C-suites, corporate boards and management, to engage in nonstop financial engineering. That is buying back stock, borrowing money to enhance their dividends, borrowing massive amounts of money to do M&A deals that might goose the stock temporarily, but in the long run, almost all these M&A deals, fail. So when the C-suites, corporate America is 100% practically focused on financial engineering, that pumps a lot of money back into Wall Street. It gooses stock prices, but it actually strip mines the real balance sheet and cash flows of corporate America, and results in less investment, less productivity, less efficiency, and so forth. Then, on top of that, you have this idiotic notion, in my view, of a 2.00% inflation target come hell or high water. Their theory is that makes the economy grow better. There's no evidence for it whatsoever. 3% inflation or 1% inflation or 0% inflation would not produce any different result, probably, than 2%. And yet, by insisting on more inflation and inflating the economy at least at 2%, they're simply driving up costs, prices, and wage levels in nominal terms, and making the U.S. economy more and more and more uncompetitive compared to all the cheap labor industrial economies in East Asia, China, and elsewhere around the world. So the Fed on Main Street causes an offshoring of productive activity, industry, and jobs. It causes the C-suites, the managements of corporate America, to underinvest in productive assets and overinvest in financial engineering. And that's why we've had the weakest, by a long shot, recovery in all of history, because Main Street is being hobbled by these Fed policies, even as it's been coupled with this fantastic, boom and recovery in the stock market that I think is not sustainable, and is based on artificial liquidity or fiat credit in the trillions that the Fed has pumped into the financial system. This is a bad deal. It's a bad policy regime, and it's seriously undermining true sustainable prosperity in America.
David, let's talk then about the tariff situation. From sound money, Mises School, tariffs on paper are bad, but at least I want to believe, and I'll let you respond to this. It's
Sure.
more nuanced than that. Will there be battles and victories won with countries playing more by the U.S. rules than continuing to take advantage based on posturing and, talking tough, what have you? Are there any goods to come out of tariffs, in your opinion?
None, zero. And the reason I say that is that when you get to fundamentals as a matter of philosophy, trade is not the business of government. And whatever they do or don't do in China, if they foolishly subsidize their industry, if they have a form of capitalism that I call the red Ponzi because it's all built on unsustainable debt, that's their problem. If American companies go to China and they're pressured into sharing their technology, that isn't Washington's responsibility to remedy. If a company doesn't want to be pressured or shares technology, don't go to China. Don't go on CNBC and bragging about how much growth you have in the future because you're in China if you don't want to play by China's rules. So this whole trade battle is a huge mistake. Trump is utterly wrong about it, about the cause of it. He's right about the symptoms, these massive deficits we shouldn't have, but he's wrong about the cause. It is not caused by bad trade deals and stupid, people in the trade USTR, the State Department, or prior presidents. It's caused by bad money. It's caused by the Fed, and also the reciprocal action of the central bank in China and elsewhere around the world. So if you want to fix the true problem, then you need to walk a few blocks from the White House to the Eccles building, clean house, and tell the Fed to get the hell out of the financial markets, to stop pegging interest rates, to stop monetizing the debt, and subsidizing the $15 trillion worth of debt that the household sector has today, and on which they overconsume and therefore over import from China. But we don't start taxing Walmart consumers who live hand to mouth anyway, and those are a lot of the red state voters, ironically, that voted for him. We don't put a tariff on them, which is what a tax is. It's not a tax on China. It's a tax on domestic users of Chinese imports, in order to get even with Beijing in terms of what their rules of the communist road are in what I call the red Ponzi. So this whole thing is going to lead to a big mess. It's not going to go away. The idea that there's going to be some moment in time like March 28th at Mar-a-Lago where they shake hands and resolve the issue cleanly and permanently on a one-time basis, that's just baloney. Trump is a statist. He has got the government now into another huge domain of micromanaging trade, and we could talk about some of the dilemmas you're going to get into. And that is just going to make the whole thing worse, but also it means that it's never going to go away. Once you start, laying out 27 different objectives that the Chinese are pledged to meet, and enforcement mechanisms to monitor and ensure that they happen, and then dispute resolution when it doesn't happen by our lights and it does by theirs. You're talking about another whole monster government operation that is the cause of our growth issues and our trade issues and not the solution. So to sum it up, Trump is putting into place a trade nanny in Washington that is only going to further hobble the ability of American business to invest, become more efficient, grow, and help raise the standard of living.
David, you called what Trump is doing at the border a border war on immigrant labor that we need. And I'm curious, what are your thoughts on that? To what extent does illegal immigration that is happening now help? And can you address, what exactly is needed with this immigration policy? Are you against a wall, for a wall? What are your thoughts on this?
I'm against the wall on the Mexican border, and I'm for a wall around domestic welfare. If you just made and enforced rules that said if you're not a citizen, you don't get welfare, period, not food stamps, Medicaid, emergency assistance, housing, any of the rest. That, in theory, is what the policy is, but it's got so many loopholes in it that it gets abused. So if you're worried about people coming here to live off the taxpayer, put the wall around welfare, make it absolutely firm, and you've solved that problem. If you're worried about crime, that is totally a function of illegal drugs, and there shouldn't be any illegal drugs, okay? The drug war, the war on drugs has been a colossal failure. It's resulted in, untold mayhem and violence at the border and in the distribution networks in America. You get rid of that. You put the job of importing drugs, give it to Philip Morris or to Amazon for that matter, order it on your computer, and all the violence would end in a few weeks or months, okay? So that's not a problem. And the third thing is, they're only illegal because it's a misdemeanor, and if we simply said at the 48 border checkpoints on the Mexican-U.S. border, stop in here, fill out a form, one page, and it's a work permit. And as long as you can get it stamped by your employer month after month because you got a job, you can stay here as long as you want. And if you're working and collecting W-2 stubs for 5 or 10 years, you can earn your way to citizenship. And the reason I say that is that the native-born workforce is actually now shrinking. We've reached the point on the demographic curve, and this is baked into the cake. You can't reverse it because the babies that would be needed to increase the workforce, 5 years from now weren't born 20 years ago. The native-born workforce is shrinking, and there is no way that the United States can remain solvent if we have a booming retirement roll because the baby boom, 80 million strong, is going on Social Security, Medicare at a huge rate in the 2020s, and have that coupled with a shrinking labor force and economy that generates less and less revenue to pay for it. It can't work. So we need labor force growth. We need much stronger economic growth than we've had to generate the revenue to pay for this welfare state that nobody wants to tackle or reform or shrink. Or if you don't do that, you're going to have a disaster. And, so therefore, Trump's war on the border, first of all, it's a phony crisis. The number of illegals, so-called apprehended at the border is down about 80% from where it was at the turn of the century, first few years of the century. It's not a crisis. It's all manufactured as a political rallying cry, but it doesn't have anything to do with, reality as far as I can tell. And it's getting in the way of the smooth inflow of workers that we need. The idea that, immigrants are taking jobs is so much baloney because America wouldn't exist without immigrants over the last 100 years. And the more immigrants we have, the more people we have working, the more prosperous we become. So that's why I say you solve the problem with guest worker permits for people to work, not a wall to keep them out.
Sure. Well, and all things I agree, and I like the way you put that. Not a wall around the border, but a wall around U.S. welfare, because that's really, I think, what frustrates people is that people come here, they take advantage of the system, and it's a system that's afforded to them, so it's not their fault. So having said that, I want to segue back to the economy. We're seeing a rising stock market after we had some volatility as we ended 2018, but we're also seeing gold rise in the face of a rising market. And my question is, are we seeing a sea change that gold is signifying anything different in the economy? Because we are seeing stocks rise, but gold's also rising. So is gold telling us something in this environment?
Yeah, I think it is. I think on the margin, it's becoming increasingly apparent, at least to people that pay attention, that the central bankers of the world have no clue what they're doing. They're making it up. They promise that, this massive expansion of their balance sheet from 900 billion on the eve of the crisis to the peak of 4.5 trillion a few months back, that was all emergency, extraordinary, 100-year flood, one time. It would get the economy back on its feet, and then that they would, retract that massive balance sheet expansion, because after all, that's just fraud. If you permanently expand the balance sheet by $3.5 trillion, like they have since September 2008, that's $3.5 trillion of fraud. They bought real bonds that funded real labor and aircraft carriers and government salaries and everything else, with credits that were made out of thin air on their digital printing press. So they said, even Bernanke said in late 2012, and Powell was already on the board by then, the Federal Reserve Board, oh, no, don't accuse us of monetizing the debt. That's, we know that's a terrible sin. This is just temporary, it's emergency, and we'll shrink the balance sheet down once things get stable. Well, here we are now, 2019, and they started to shrink the balance sheet. The market gives a little hiccup for a couple of weeks in late December, and all of a sudden what was on automatic pilot, as you recall, the balance sheet QT, the shrinkage, 600 billion a year, is suddenly not only on pause, at least rhetorically, but they're leaking to the press, and they're getting Goldman out there to pronounce officially that the balance sheet shrinkage will be over by September. Well, if you do the math, they can't get it under 3.6 trillion, and it really shouldn't even be much more than 1 trillion, where they started 8 or 9 years ago. So what they're doing is Bernanke was lying, or in the face of a hissy fit in the market, they're making up another excuse to keep to attempt to keep the bubble going. But I don't think they're going to get away with this indefinitely, because with each twist and turn, I think more people recognize they're just sliding by the seat of their pants. They're making it up. I mean, there's stupid theories that they keep coming up with almost every day, like, well, we've undershot our inflation target of 2%, which in itself is dubious. I mean, there's no real reason for a 2% inflation, except it gives them an excuse to have easier money and lower interest rates. But now they're saying, well, we had quite a few years where we didn't quite make it, so we should have price level targeting, not price change targeting per year. And if we undershoot for a few years, we get to overshoot for a few years in order to catch up. I showed the other day, and something I put in my blog, that, well, if you go back to the year 2000, and you said they must absolutely keep the PCE deflator, which is their favorite measure of inflation, the PCE, personal consumption expenditure deflator. If you kept that at 2.00% year after year, then it would be at 143 today. compared to 100 in the year 2000. But it only is at 138.5. So what they're really saying is that the economy would be much better today if the PCE deflator were at 143 versus, let's say, 139 rounded. That's it. That's ridiculous. There's no basis for that. That's just a made-up excuse for why they are going to duck and dodge again when it comes to the real issue at hand, which is normalizing monetary policy and getting their big fat thumb off the scales in terms of interest rates. The same thing is true with this new invention that they toss around called R-star. Now, this is supposed to intimidate you because it sounds like it's algebra or something. Mm-hmm. And what it really is the so-called natural rate of interest, which they divine to be 2% at the present time. This is the money market rate, rather than 3 or 4% that used to be the case, or as it was previously viewed. Now, here's the point. R-star, it doesn't even exist. It's totally an academic fiction that is being made up by the same central bankers who want to use it as a justification for keeping interest rates at the absurdly low levels that they're at today. Well, what I'm saying is they're just making this whole thing up. It's complete nonsense. No one can know what the natural rate of interest is except the market, and they don't let the market work. They peg the interest rate. So it's just another example of why it all relates back to gold, that these jokers on the central banks have backed themselves into such a corner of so much illogic and false promises that the market's going to figure out they've failed. And when it becomes clear that central banking, the modern version, I call it monetary central banking, the central planning, has failed, there is going to be a fairly substantial rotation to gold as the one asset that these failed bankers, central bankers, can't destroy, create, or in other ways distort.
Well, I would definitely agree with you on that, and I'm very optimistic as to what we're going to see in gold this year. I really was pounding the table earlier in the year, and that's really how we started off 2019 was, hey, you got to be looking at gold here in 2019, and sure enough, it's turning out to be a really exciting asset class to be looking at, especially if we start to see things come unhinged going forward here, which you strongly make that case. So having said that, David, please give us some closing thoughts. And if people want to learn more about you, what you're doing, read your book, let them know where they can go and what they can expect to find. Okay, well, the book, Peak Trump, the subtitle, I think, is more revealing. The subtitle is The Undrainable Swamp and the Fantasy of MAGA, Make America Great Again. That is available on Amazon, both the ebook and the printed book. And it is a pretty good summary of how we got here, why Trump got elected by Flyover America, because clearly they've been left behind in favor of Wall Street. But what needs to be done versus what Trump has proposed, which will, in my view, only make matters worse, not better. So that's one thing. The second thing is that I do publish a newsletter or blog, whatever you want to call it, daily of commentary about all the things we've been talking about today, the Fed, the financial markets, stocks, Washington policy deficits, what's going on in the world, plus foreign policy. I'm a very big non-interventionist, anti-empire, pro-America first
guy in my orientation, among many reasons. One, it's not our role to police the world. No one, endowed us with that capability or right. And second is bankrupting America, because the warfare state, as I call it, costs more than upwards of $100 trillion a year if you count all the debt that we pay for wars and all of the veterans that we have to take care of, who are victims of these unnecessary wars. And it's bankrupting us. Between the welfare state and the warfare state, it's no wonder we have the fiscal crisis that we do. Well, my daily blog, which comes out 5 times a week, called David Stockman's Contra Corner, addresses all of those things, and you can just Google it, and it'll take you right to the site to sign up.
Absolutely. Well, thank you so much, David, for coming on Crush the Street. Your time is very appreciated here. And again, we hope to have you on in the near future.